Welcome back to the Max Your Dash podcast. Thank you for listening, liking, sharing, and now watching. I am your host, Steve, joined by my co-host, Nate, and Mark is here with us again today. What's going on, fellas?
Enjoying that spring is here.
It is here.
It's like hot. I got to take this long sleeve off.
Dude,
outside.
It was nice.
I'm hoping to be able to step outside today while it's nice out, get some fresh air. Maybe mow the lawn.
If you believe in the Max Your Dash mindset, like if it's truly a way of life for you, that would be something you would prioritize.
I'm hoping to be able to do that. I think I'm going to be able to pull it off today.
Okay. All right. Good.
It is supposed to snow next week, though. Hopefully you guys don't hate that, but it is.
What?
Yeah, it's supposed to snow.
Nah.
Golf League starts on the 24th, I think.
Is that 2 weeks from now? Today is April 12th for our 25th. Listeners. We're filming this on April 12th. Guys, let's do some Max Your Dash moments before we hop in today's fun, awesome topic. Also, I've been getting feedback that people listen to our Max Your Dash moments. People are doing
They
it.
listen?
People are listening to them.
Was that because it's in the first 5 minutes?
The first 5 minutes. Nate, you're up.
Okay. My Max Your Dash moment is that I take my lawn care pretty seriously at my house. I love like getting the stripes going and
Wait, did you already mow your lawn yet?
Nope, but the other day because the weather's finally nice, I went out and fertilized the lawn and threw some seed on there and I'm ready to go.
And you love that?
I literally love that.
My dogs just poop all over my yard for fertilizer. We're good. Got a ton of natural fertilizer out there.
How long does it take you to mow?
Like an hour and a half to 2 hours probably. I got to mow probably 2-ish acres.
That's a long time, dude.
Here's a question I have for you guys because you guys make fun of me. I like to be outdoors. I like to enjoy myself. I asked one of my buddies this the other day, when was the last time you guys actually went outside and just looked at stars?
At your house, probably on your deck.
When do you think literally was the last time you just were like appreciating?
It was
the sky?
actually not that long ago. Wasn't there like a solar eclipse or something recently?
Oh, yeah. That's kind of cheating.
You are big into that stuff, Mark.
I used to be like, I think I still am. I just don't put any effort into it. I love space. I think it's cool.
4th of July at your house, probably.
I think
you got a good setup.
I think there's
for that,
an opportunity to enjoy nature more.
I think so.
All right, I'm done.
Mark,
I'm gonna go with. Well, I guess it was the second, but Enzo's second Easter, but the first one really doesn't count. I don't think. Right? He was basically non-existent at that time. But it was fun. We were just chasing him around all day. He was crazy, like running up and down stairs. It was just fun to see him kind of in a year later.
Did you guys do like an egg hunt?
What's that?
Did you do like an egg hunt?
Yes. So we, this is funny. So my mom, Vic. So
shout out Vic.
My niece is like 18 almost. My 2 nephews are in high school. For some reason, she was doing an Easter egg hunt for them and Enzo. So we of course obviously made fun of her, but Enzo did participate in that a little bit. He got like 1 or 2 eggs.
Nice. It was like every man for himself.
Yes, it was a wild hunt.
There you go.
But yeah, it was cool. It was a fun, chasing him around nonstop. When you're out of your house, nothing's baby proofed like at home. Mm-hmm. So you're like constantly on the move, which can be annoying, but it was funny too.
Nicole was so excited she got this outfit for Grayson to get like an Easter picture. Mm-hmm. It's a big deal when you got little ones. He was sick over the weekend. She puts it on him, and immediately within the first 5 minutes before we could take a picture, he puked all over himself. So we have no Easter pictures in the Elmer's house.
Yeah, I think my Max Your Dash moment is Easter too. It's funny because my niece, my sister's kid, is like the same age as Enzo, so he and Grayson, but they were like we were also doing an egg hunt, but dude, they like don't even know. They're like, all right, come get this egg. It's like they're not hidden. They're just on the lawn.
Yeah.
But they're like not even really doing it. But they're literally just picking up the egg and like putting it in the basket, and then they're like, all right.
So for Enzo's, like Yeah, we didn't get him like a real Easter basket. We put a bunch of stuff on this chair that he got for his birthday. And I think like one thing was new, maybe two balls and like a coloring book or something like that. The rest of it, we just put toys or gifts that he already had gotten and just put it on there. And it was funny. Like the first thing in the morning, he runs over to it, starts pulling stuff off the chair, but like none of it was anything new. They don't know the difference. You could have put 2 empty eggs outside, and that could have been the Easter egg hunt.
It's going to be funny. Like, they grow so fast. So next year, Easter with them is going to be completely different. Yeah. They're going to be like talking and stuff, right?
Yeah, I would think next year will be crazy.
Yeah.
Like 2 years old, they should be.
I'm going to be hiding that basket.
You should know at least.
In a tree.
It's going to take him forever to find it.
Yeah, Christmas should be fun too.
All right. Max Your Dash moments. Hopefully, we have some good weather Max Your Dash moments for next podcast, probably. If we don't get snowed in.
Oh, boy.
Today's topic. We're talking about asset allocation, so, the investing talk, but we're talking about maybe one of the most important part for investors, which is risk management in your portfolio. What that really means, why we believe in it, and why we think it's important. Which, you can probably boil it down to like everyone hears what are the biggest buzzwords around that, you think, like diversification, all that stuff. But what does risk management really mean? Like, what is risk management in your portfolio mean?
Mark, this feels like a you thing.
I would say to me, and it should, I guess, for most people, it means lowering the risk that you're taking inside of your portfolio by being diversified.
Why is that important?
So if you're a client of mine and we've talked about investing, I've probably said the phrase time in the market is better than timing the market.
Yep.
So I believe that risk management, asset allocation in a portfolio better enables you to stay in the market. And that's why I think it's so important. Just stay in the market. Don't try to time it. Ride the ups and downs, and your long-term performance is going to be better than trying to time the market.
We have said this so many times. Staying in the market might be the most important thing for an investor, no matter what you do. Staying in the market might literally just be it.
Yeah.
But easier said than done.
It is easier said than done. And I remember early on in my career, you'd hear people talk about this, and then, you kind of just, I don't know, it makes sense, but like, I never experienced like somebody that actually did try to time the market and like the impact of that. And now in my career, I can think of examples of people who literally took their money out at the worst possible times, and how like just horrible of a decision that is. And the thing is it's like very rational though, to the markets are going down. The news headlines are horrible. Your friends are telling you the world's ending. Okay, I need to salvage what I can and take my money out.
Yeah.
And it's rational, but it's not. It's the biggest mistake you can make.
Yeah, get into the human behavior part, because like your brain, you want to stop the pain, which is your account going down. So your instinct feeling is I should sell, but it's the opposite of what you should do.
Yeah, like our brains are wired to avoid problems and conflict, right? And so think about when your life savings is going down at a really fast pace, your brain is telling you like to do something about that, right? And most people think like it's just easy, like, oh, you should have known that it was going to go down and you get out before it happens, or, on the way down, I'll get out now and then I'll get back in sometime later. The actual practice of doing that is impossible.
Right.
And it's just, we wish, right, that we could time everything perfectly, of course.
Yeah.
But it literally is impossible because things move so quick.
Yeah. The easier said than done part comes from like, if you're listening to this, you're probably like, oh, I'll just stay in the market then. I'll just never sell.
Yeah. Yeah. I think so. I do think it works both ways. You get people who are like, oh, I'm down 20% on this stock that I bought, or this play that I believed in at one point, and they aren't willing to get out of the position because they think, oh, I'm just going to wait for it to come back up to get to zero and then get out. Like, that doesn't make sense either. So timing the market isn't just buying at the bottom; it's also trying to sell at the top. Right. So you don't know when those two times happen until after the fact.
Yeah.
And a lot of people did get lucky actually timing the market back in COVID. Buying in March 2020 or something like that. They had this massive run up, but who got out? Because all of those stocks that had the massive run up, they're actually back to probably negative territory now, and pretty bad negative.
Yeah.
Yeah.
What's cool today too is we have some actual like specific numbers and slides here that we're gonna put up on the screen too. For some of them, we really think we want you guys to see. But you're really going to see the impact of having risk management in your portfolio and why we think it's important. This is going to be educational, but it's also very timely for what's been going on in the market the last couple of years. And when this thing ends up turning around and goes green again for a long time, it's just going to be another lesson for investors on why you shouldn't have sold and you should have stayed the course regardless of what's going on. It's interesting because like, if you think the market is ever going to fail, we now literally have a timestamp in history where people thought the world was ending because of COVID, and it still didn't end.
Yeah.
You know what I mean? Like, what more worse could happen than the crazy headlines of that, and the market still survived?
Yeah.
I think you'd be surprised.
I guess so.
I think there's this conspiracy theorists out there still waiting for it to happen.
Yeah.
They're still trying to be right, and it just hasn't happened.
Yeah. So why don't we pull up that first slide there, Mark, that you talk about? It's a diversification of average investor, right? So talking about how the average investor does compared to a diversified risk managed portfolio. Okay.
Yeah. So I know we're going to talk about like the theory of just buy and hold an index fund, right? So if you did that over the last decade, you would have had a 16% average rate of return, which is awesome.
Great.
The average investor over the last decade, 8.7%, compared to a blended portfolio, 11.1%.
This data is from the Delbar study or
JP Morgan?
JP Morgan. Okay.
So it might be from the Delbar study. I don't know.
Well, yeah. I mean, every year there's an independent organization called Delbar that does a study to show this same data, to show the difference in the average investor's performance to the S&P 500. And it's always the same story. We talked about this on this podcast, I think, a couple times.
Yeah.
Investors usually are capturing like half the return of the market. And the explanation is very simple. They try to time the market.
Probably half the return with the same volatility or risk, which is terrible.
Which is crazy. Like if you had literally bought an S&P 500 index fund from 2012 to 2021, you would have gotten a 16% rate of return, but the average investor did half of that.
I like this example too, to like kind of let's walk through an example of put yourself. So for everyone listening, imagine this is you. I think the great financial crisis of 2008, 2009 is a good example to use. Let's imagine you're that person who's like, I'm just going to buy and hold the S&P 500 my whole career. And we've talked about this on the episode before where it's like, that's easy to say and do when you have like $5,000 in the account, but when you got $1 million in the account, the swings hurt a lot more. So if you had started in January 2008 with $1 million, by January 2009, you'd be down to $511,000. And then imagine, I wish we could pull up like what were the news headlines at that time.
Yeah.
Imagine what you'd be feeling. You've lost half of $500,000 you've lost. And the headlines are probably really bad still. So are you really disciplined enough to stay the course? Like that's what we're trying to talk about today is it is true that if you buy and hold the S&P 500 forever, you're probably going to do great.
Yeah.
But the actual practice of doing that for the average person is impossible to follow through on because of these types of swings that will inevitably happen. Like we're picking that one example. COVID would have been another one, right? Last year would be another pretty decent example of like, would you really be riding it out? Imagine today you're hearing about banks failing and the US dollar is going to go away and all this crazy stuff that people are trying to put out there. It is so much harder to stay the course than you think it is.
Yeah. Well, think about it. Let's just say in this scenario, it took you 20 or 30 working years to save up $1 million, and half of it is gone in 1 year. You think that, buy and hold the index fund solution in your head is going to hold up? Probably not.
Right.
That is a really cool, like to see that impact. Bring up that, the impact of missing the best days. So let's say you start like trying to time.
Yeah.
Right. So that actually starts happening and you're getting in and out of the market. What ends up happening to your portfolio then?
Yeah. So that before I'll pull that up in a second and then it's going to be answered on the next slide too. But the whole thing that Nate's getting to there is, okay, why is the average investor performance half of what the S&P 500 did? That's all behavior. And it's because, it sounds easy to just buy and hold. And after that, that's probably where a lot of the recency bias came from, is after 2009. If you just bought and hold the S&P 500, you crushed it. Right?
Rocket ship.
But what did you do at the end of 2018? What did you do during the COVID crash? Did you actually stay the course? Did you stay the course through 2008, 2009? Very unrealistic.
And again, I think a lot of the people who talk this way are like 25 to 35 years old and don't have $1 million.
Right.
Yeah. It's a lot easier said than done on a small account balance.
Yeah.
Yeah, I'd agree. So the being diversified is helping the behavioral side of things. It's making it easier to stay the course. Yeah. So again, average investor performance over the last decade, 8.7 compared to the S&P, 16.6%. In a diversified portfolio, 60% stocks, 40% bonds was 11.1%. If we look at how does that happen, and that impact of not staying in the market, if you were fully invested from January 2003 to December 30th of 2022, your rate of return would have been 9.8% in the S&P 500. If you missed just the 10 best days, that 9.8% becomes 5.6.
Dude, crazy.
And I don't know if you have this chart handy, but I remember we've looked this up a bunch in the past, where usually the best days follow the worst days. And so when the market's down 10% in a day, and the next day might be the best day, but it's going to feel the hardest to actually be in the market.
Right.
So if we look at the actual stats on that, so 7 of the 10 best days occurred within 2 weeks of the 10 worst days.
Dude, that's
6 of the 7 best days occurred after 6 of the 7 days occurred after the worst days. The second worst day of 2020, March 12th, was immediately followed by the second best day of the year. So that's, it's pretty easy to miss the 10 best days, is what we're trying to say.
In a 20-year time period, if you miss 10 days, it cuts your return in half. Yeah. Well, 10 of the best days. But the odds are against you, because the best days follow the worst days, which is when you're going to want to sell.
Right.
Yeah. 7 of the best were within 2 weeks. 6 of those 7 occurred the day after the worst days.
It's crazy.
So if you got out, there's a very high chance that you missed the best days.
Right.
There's almost no chance you got back in on the right day.
The greatest investing quote of all time, if everyone could just remember this and let it be a part, tattoo it somewhere on your body. Warren Buffett: be fearful when people are greedy, and be greedy when people are fearful. Back in 2021, when everyone's greedy and there's NFTs everywhere and everyone's telling you to buy cryptocurrency, and you start to get all this FOMO feeling, that is the time to sell.
Yeah.
Now everyone's the opposite. Everyone's thinking the world's ending. Now's the time to buy.
Yeah.
And if you could just embrace that mindset, you will do great long term.
That, talking about how quick those swings are, I think the COVID crash, we don't have the numbers up, but that happened in March, the really bad couple of days of minus 10 or minus 15. And it went back up so quickly after that. Yeah. It was literally a couple days after.
That's another thing that I've often thought about lately, is the advancements in technology have also made the swings and the volatility even more intense. The algorithms and these trading tools and stuff that it's going to be even harder.
That's a good point. Yeah.
Because of how fast stuff can happen now.
So I think that if you're listening to this and you're hearing that, I think that should drive home a pretty good point that risk management in your portfolio is important for just human behavior in general.
Yeah.
So what's the solution to that? When we say risk management in your portfolio, we mean asset allocation, right, Mark? So what is that?
Yeah, sorry, I was looking to see what that.
Well, I'll kick this thought off.
2020 there. It was intra-year decline of minus 34%. So if you just wrote it out, if you didn't get out of the market, you would have finished the year up 16%. Meanwhile, there was a drop of 34% in that year.
And 80 headlines saying the world's
And
ending.
that 34% drop was in a month.
Yeah.
So that we were living through that.
Yeah.
That was crazy.
It was.
But
so the answer to this is asset allocation.
Yeah, so asset allocation, to kind of intro this, and then Mark can get a little more geeked out with it, is like, so different asset classes have they move differently in relation to each other. We call this correlation, right? So, when U.S. large cap will perform differently than emerging markets will perform it based on different economic trends and macro trends that are happening. And so it's because like we just said, it's like impossible to predict what's going to be the best. Having a mixture of all of that is important, and trying to get your portfolio to be diversified in such a way that as things go down, you're not capturing that full loss, which should help you stay the course, which is the biggest point we're trying to make here.
We always say this, asset allocation should just smooth out the ride. You're not trying to beat the S&P 500 or an index fund with asset allocation or a diversified portfolio. You're just trying to smooth out the ride. And like you showed the diversification of the average investor, it doesn't return what the S&P does, but you're able to just smooth out the roller coaster of the volatility of the market.
Yeah, I think this is kind of a fascinating page here. So if you look at a 50-50 portfolio of stocks to bonds dating back to 1950, if you look at 5-year rolling periods dating back to 1950, never one time during that period was a 50-50 portfolio negative. Okay, so if you can at least hold for 5 years in a 50-50 portfolio, you would have never experienced any negative returns in that 5-year rolling period, with an average rate of return of 8.7%. 8.7%. That's really good.
Yeah.
That's all just from being diversified, relatively low risk, I would say. The worst 1-year performance in that portfolio was minus 15% compared to an all stock portfolio of minus 39%.
Yeah. Well, so when we say be diversified, what does that actually mean?
It means spreading your money out across different asset classes. So that's the other thing, is we can dive into like more specifics of that, but I don't think we're going to go too far in it, but it's not as simple as just buy the S&P 500 for your stocks and buy the ag for your bonds. It's more than that. There's mid-cap stocks, there's small-cap stocks, there's emerging markets, there's international developed markets, there's different parts within fixed income as well. There's a ton of different asset classes that we're not really going to dive all the way into the depths on, but
don't put all your eggs in one basket.
Correct.
And then there's sector diversification. So like for us, when we're building a portfolio, we're looking at all of that, and we're trying to optimize the portfolio to have the right percentages in not only different asset classes, but different sectors. And the average person, like, this is too probably high level for you to necessarily do. But the point is like, you need to spread out your risk.
Yeah. You want to be always trying to get the highest amount of return for the lowest amount of risk, which I think the quilt, I'll probably put this page right up on the screen, but this is perfect to see, because if you just look at the asset allocation, the white, it really just like stays in the middle. There's no crazy swings like a lot of these asset classes. Imagine if you were just invested into small caps or something like that. Think about the swings.
Yeah.
Yep.
Yeah, I mean, look at commodities before 2021. They were always at the bottom. Right. So if you're trying to time asset class performance and you're like, I'm just going to buy the worst performer last year. Well, you would have been wrong a bunch of times if you were buying commodities.
Yeah.
But the last 2 years, they were up there. Right. 2021, third best performing asset class. In 2022, they were the only positive asset class besides cash.
Yeah. So think about that. Look at the volatility from 2008 to 2022, the score of where asset allocation is. Besides bonds and cash, you can't get more safe than cash. Bonds are a bad example recently, but still, traditionally bonds are a safe place to park your money. There was nothing less volatile than the asset allocation model. There was no other asset class less volatile in that time frame.
I think that we can do a better job of educating people on, like, everyone gets their statements and they look at their performance. I don't think most people understand what standard deviation stats are or beta stats are, like the risk stats of a portfolio. I'd like more people to understand and be paying attention to what those stats are too. Do you think that's good to maybe mention?
Yeah, I mean, that just leads to, like, you got to know what your benchmark is. And we were kind of talking about this yesterday, but if you're always just going to compare your investment performance to the S&P 500, then you need to at least be taking as much risk as the S&P 500 to do that. Right. So I think there's like a misconception there, because everyone says like, what's the market doing? How's my portfolio doing compared to the market? Well, that's not really the right question.
Right.
How's my portfolio doing compared to my benchmark?
Right.
Based on the risk level I'm taking, how am I doing? What
Yeah.
are my risk adjusted
Right.
returns, in other words?
Yeah. You would never compare how the ag is doing compared to the S&P
Right.
500 because they're trying to
Right.
accomplish
Yeah,
different
why doesn't
things.
that ever happen? Why isn't that ever the index that people are comparing their portfolios to?
That's so interesting. I think would our answer be this though? Like, if you truly can, like you can't say this, but if you truly say, how should I invest? If you say that you can stay the course with an S&P 500 index fund over 40 years, if you don't sell once, do that.
Mm-hmm.
That's better than asset allocation.
Probably.
Yeah.
Yeah.
If your goal is just returns.
Mm-hmm. Yeah, because I mean, it makes sense. Like the 500 largest U.S.-based companies over time should be growing at a really great rate.
Mm-hmm.
If they're not, it means that our economy is really slowing down, and that would be really bad for the world. But like we pointed out in that example, if you had $1 million in January 2008, you had 500,000 in January 2009. Can you really ride that out?
Yeah.
And here's the other thing too, right? Is for most people, you're saving money like in your 401k over time or whatever. And when you get to millions of dollars is like later in life. And so when you're 50, your time horizon is a lot different than when you started the 401k.
Mm-hmm.
Yeah.
But now is when you have the most amount of money. And now is when the swings hurt the most too.
Right.
Mm-hmm.
So it's just like, are you really going to be able to do that? God bless you if you can. I mean, I don't even know if I would have.
Right.
I'm a financial advisor. If I had $1 million in January 2008 and I had 500 in January 2009, I'm freaking out.
And banks are shutting down.
Yeah.
It's crazy.
Yeah.
So you said something there about time horizon. Your asset allocation does change as you get older. We're like, we'll talk about a little bit about how your asset allocation changes over time as an investor, Mark.
Well, so we use a bucketing approach. So like basically the dollars that you're spending sooner are going to be invested safer, right?
Mm-hmm.
And the dollars that you're spending later are going to be invested more aggressively, right?
Drop,
So
drop the tagline. What's this called?
What time-weighted asset allocation.
It's Mark's favorite.
So you weight your asset allocation based on the time that you're going to spend the dollars. So, you know, you shouldn't have all of your money invested the exact same way, is a different way of saying that,
Mm-hmm.
right? The money you're touching soon should be conservative. If you're spending it in the next few years, it should probably be in cash or something like cash.
Yeah.
At least with, you know, knowing the downside to that portfolio is very important.
Yeah.
But the longer term money, you know, if you're 60 years old and we're planning on you living to 100, well, that's a 40-year time horizon. That was the same as when you first started investing, right? So some of that money needs to be allocated for the later half of your remaining life.
Yeah.
And that allows for higher performance. Now, that's coupled with more volatility, but that's okay. Who cares what's happening in that portfolio in the near term, because we're not touching it for 15 years.
Right.
So I think that answers.
No, it did. One of my favorite lines of yours, Mark, is your money is like a bar of soap. The more you touch it, the less you have.
Mm-hmm.
Which I know that kind of circles back to missing the best days. But if you just like, the more you're trying to do things with your portfolio, the more chance you open up for something to happen.
Mm-hmm. Yeah, it's true. Yeah, I mean, it's taking money out at the wrong time is probably like the biggest impact, I would say, on your portfolio.
And this is what everyone will say. You talk to Warren Buffett, you talk to anyone, this is what they will say. 100%.
Yeah.
So how would you, so I brought up a minute ago, like that more people should be paying attention to the risk measures of their portfolio. Educate our listeners on what the important risk measures are of their portfolio and like what they mean.
So, I mean, I think the biggest one is standard deviation, to understand that. And we've been talking about that diversified portfolio. So for example, like the asset allocation model has a 12.4% standard deviation or volatility metric, with an average rate of return over the last 14 years of 6.1%. It's taking about, 30 to 40% less risk and getting about 75 to 80% of S&P returns. So from like, what do you track? That the measure of risk there is standard deviation.
Yeah.
So I think that's to me like the most important one to be paying attention to. Or your Sharpe ratio.
The higher it is, the more
swings,
the volatile the investment is. The more volatile your portfolio is.
Yes. So I mean, like if you came to me and you said, like, why isn't my portfolio doing the same as the S&P 500? I would have to bring that up. Okay, what's the level of risk that you're taking? What's the standard deviation that you're taking?
Right.
If you're taking 30% less risk, you should be getting it somewhere around 30% less return. You would hope, right? Yeah. So beta is another metric of that, right? So if you have a 1.3 beta to the market, you're expecting 30% more returns.
Right.
And beta is just how your portfolio moves in correlation to the market.
Correct.
If you have a beta of 1, your portfolio will move with the S&P.
Right.
Would you say that like our goal when helping clients is we want to identify what's the growth rate we need to achieve your goals, and let's build a portfolio to get that with the lowest possible standard deviation.
Yes.
That's what we're trying to do for our clients. There's an efficiency there.
Yeah.
Like that we're trying to optimize for.
And then like, so again, not to bring in timing, trying to time the market, but there's some things that are obvious. And we talked about SVB and that whole banking situation, I think on the last podcast, but anyone could have seen rates having to go up. I don't know how they mismanaged that so poorly, but buying long dated bonds makes no sense when rates are at a bottom, unless you're just hoping for more decreases in rates for better price appreciation. But you when you're paying attention to like market cycles or economic cycles, and we're going through this period of probably potentially heading towards a recession. So these things are normal. It's okay. This is supposed to happen. It gets things to a point where we can kind of create a new path forward, a new sustainable path forward. And so another level that we take into account here is like, okay, if we're heading towards a recession, we want to be allocated into sectors or that are going to perform better or not as bad heading into a recession, right? Get defensive in your portfolio. So that's part of this too, is, how do we not only diversify amongst all these different asset classes, but within those asset classes, how do we take it a step deeper to optimize it? And that's where things get really hard, I think, for the individual investor,
right?
To try to build a asset allocation model and maintain that over time.
And that's why the advice that's out there is just buy and hold, because you're never going to have the time to do the research necessary to do all this stuff. But then the problem with buy and hold is what we talked about.
Right?
Are you going to really follow through on it?
Right. Yeah, I mean, exposure, this is going through the individual asset allocation of an investor out there right now in a 60-40 portfolio is incredibly overweight U.S. equities and incredibly underweight international equities. We are right on the precipice of this should flip. The international outperformance should be happening as the dollar weakens. And we're in a decreasing rate, is kind of the next step here coming down the road. While they're raising rates, right. And I'm not expecting them to decrease significantly, but if we do cut rates and international, they start to increase rates, their dollar is going to strengthen, ours is going to weaken. That leads to international outperformance. Not a recommendation to go buy international stocks, but that's kind of what we're being hired to do.
But that's the stuff that we're constantly evaluating, constantly losing sleep over, trying to figure out the way to optimize our client's portfolio for that stuff.
And if you can't do that stuff, but that's why buy and hold, like you said, is the best way to do it.
If you can stick with it.
With it.
Now, guys, we talked about like some really, really gold nuggets here. So let's start to wrap up. But were there any like other little charts here, Mark, that you wanted to touch on to drive the point home? I mean, like a lot of these are just saying the same thing in a different way. We wanted to just explain it, why risk management is important and why buying and holding an index fund may not be the best solution for 99% of people. And I think we've driven that point home, but is there any other ones that you wanted to go over here?
Or are we going to get crushed for saying that? Like,
I hope. What are they going to do? We got the evidence. We literally have the evidence. What are you going to say?
No, I mean, we talked about like being right on your, getting lucky on time, timing the market after COVID and just looking at this chart here is really interesting. If you look at since the market low, March 2020, small cap value and mid cap value are their best performing asset classes since then. Year to date, they are two of the worst. They are the two worst performing asset classes, right? But at some point, and we could probably go find the specific month, this chart looked the opposite. It was like if you were in small and mid cap values compared to large and mid cap growth stocks, this looked completely different. Those were the best two. Now they're not. They're two of the worst ones compared to small and mid cap values. So that's, you can get lucky, but did you get out? Right. I feel like everyone likes to ride that stock that they're in love with and doesn't want to get out of it at that high point because you just think it's going to keep going. And I get it. I mean, I've done it. I've made that mistake.
Right.
It's okay, but maybe even if it's still not back to where you want it to be right now, it's something to consider. Is that all the juice you're getting out of this thing anytime soon? Is there a better entry point coming for that stock down the road? But still kind of a timing.
Yeah, there's so many factors that play into you touching your money. Mm-hmm. So it almost makes like complete buy and hold management impossible, like you said. We don't want to say it's impossible because there's probably someone that can do it, especially the 20-year-olds who are like, "What? Of course I'm going to do it." You know?
Yeah.
Anything on your side, Nate?
I don't think so. I think the main point here is you got to have a discipline and a process, and it's just so much harder to fall through on to say that my discipline and my process is I'm going to just buy and hold something forever.
Yeah.
But I think we've hammered that point.
Human behavior might be more important in investing than the actual technicalities of it. Mm-hmm. Because think of how much of a role it plays. Who cares all the fun portfolio stuff you do, Mark? If you got terrible human behavior, you don't know anything about your emotions, you're not disciplined, that doesn't matter at all.
Yep. Mm-hmm. Yep.
So,
and I would say right now, if you kind of just look at the environment we're in, when you start hearing like your friends or coworkers or people talking bad about investing, that's the signal that it's really close to, it's time to write a check into your account.
Yeah.
And that's kind of happening right now.
Mm-hmm. I would say, one last thing to add in about asset allocation. I think if you're believing this philosophy for your investments, you believe in diversification, you believe in asset allocation, you have to understand that you are never going to be right and you're never going to be wrong. Mm-hmm. Right. So you're never going to be in the best performing portfolio and you're never going to be in the worst performing portfolio. So if you always want to be kind of right and not wrong, right? That's the way to go.
Yeah. And focus on, are you getting the return necessary to achieve your goals while lowering the risk as much as possible?
Right. Yeah. What is your goal as an investor?
Yeah. Yeah. Is it to keep up with the stock market or is it to achieve some rate of return to hit your retirement goal?
Mm-hmm. Yeah.
All right, we got this.
I think we did. Yeah, this is some really good stuff. This could this isn't Warren Buffett talking about this stuff, but this is a golden Bible of an episode. I feel like with some stuff like these are core principles of what every investment manager thinks about 100%. So hopefully you guys found some value in that.
I think it's as simple as be diversified, dollar cost average, and hold. Don't move. Just stay. If you're in a diversified portfolio, there's no reason to change that. Stay that way. Keep adding to it, and just ride things out.
Don't miss the best days.
Yep. Don't miss the best days.
Cool. If this is something I wanted to say too. If you guys are watching all the way through, we really appreciate it. If you're not subscribed on YouTube, please subscribe. But also go on Spotify or Apple Podcasts, wherever you're listening to this, and either just hit the follow or subscribe button. I know it's like a different word in each platform. But that'll obviously give you a notification on when we post something. But it also helps us as we continue to grow this. And if there's anything at all that you guys want us to hear talk about on top of the stuff that we already have planned, because we try to fit like themes with certain months and stuff like that, we'd be happy to talk about what our listeners want. So feel free to shoot us an email or DM us on Instagram. It's just @Capital Advisors. So anything else, guys?
Nope.
All right. Thank you for listening and watching the Max Your Dash podcast. We'll catch you guys in the next one.
Securities offered through Securities America Inc., member FINRA SIPC. Advisory services offered through Security America Advisors Inc. Dash Capital Advisors and Securities America are separate entities.